Hi guys, welcome to this Moneycontrol live stream. This morning we woke up to some tragic news of, investing legend Charlie Munger really passing away. And of course, he is somebody who was a right hand, more than a right hand, and close confidant of, legendary investor Warren Buffett himself. And he has helped Buffett build an investment powerhouse, so to say. If you talk about Berkshire Hathaway, right, Santo? He was somebody who liked to take the backseat and let Buffett be the face of Berkshire. But of course, this has come as a huge loss to the investing world. In fact, a lot of these legendary investors back home also hero worshipped him, and there were quite a few learnings and takeaways from his quotes. He was known for his wit as well as one-liners. Lot to take away from there. Plus, also his outlook on investing. That also stood out for many investors. And over the years at the Berkshire AGM, everybody is used to seeing him sit next to Warren Buffett and field questions from shareholders, right? So it's come as a big loss. And I just want to point out that he would have completed his 100th birthday just about a month from now. So before achieving that milestone, that magical figure of 100, we have seen the tragic passing away of Charlie Munger, right? But Santo, over the years that you have tracked, Berkshire AGM plus the benefits of compounding and his investing style, what is it that really stuck with you?
Well, there are plenty of quotes, but the best part is that, if you were to just, distill it, I think he would constantly emphasis on 2 or 3 key points. So, one is patience, one is discipline, and the third one is keeping things simple. So, if you're able to do these 3 things, a lot of your problems are kind of fixed. So, there is this favorite quote of his, or his quote which I've always quite found it very interesting and very inspiring also. It says that, what best a human can do is actually help another human being know more. So, this is nothing directly to do with investment, but this has also been one of my favorite quotes of Munger outside of investing. But among the other quotes which I liked and I can relate to it in a big way is that when he says that it's not the buying and selling that makes the money is not made in the buying or selling, it is actually in the waiting. So I've been tracking markets for a long time, almost 20-25 years.
But that's what investors don't tend to do.
Right.
That's what we new age investors need to learn from Munger's teachings, right?
So over these many years, you will see some investors managing to identify stocks, right? But very few of them are able to ride it out till the very end. Very few of them.
The importance of being patient.
Being patient. So that's, I think, 3 qualities I would say, that patience, discipline, and keeping things simple. I think this in a nutshell is the legacy that Munger leaves for the investing world.
Right, a rich legacy indeed. And let's also bring on board now market expert Ajay Bagga to talk about what he has taken away from his philosophy, as well as the one-liners that I mentioned. So many quotes. They do tend to have some bit of teachings behind them, right? All his quotes, if you look at them. Welcoming you on the show, Mr. Bagga. A rich legacy being left behind. Of course, there will be a void in the financial world, with the loss of Munger. What is it that what is it that sticks with you when it comes to his sayings, his philosophy, and has it influenced your style of investing in some way?
No, absolutely. It's an influence on a way of living also, Nandita. And I would say it's a celebration today. We should not feel sad. He had a very full life, and right till the end, he was working. I have seen 3 legendary investors like this in the company I worked in, Pioneer Boston, which had Kothari Pioneer as its JV in India. I had read about and met proteges of Phil Carey, who in 1929 wrote the book The Art of Speculation. So he was one generation elder to Warren Buffett and Charlie Munger, who were both, born in the 1920s. But more than that, I think what Charlie Munger leaves behind is a huge cachet of investment wisdom, of wit, of commonsensical approach to life and investments, a lot of discipline, as Santosh mentioned, and clarifying a lot of complexities into very simple, followable, actionable kind of points. So the big shift, I would say, being children of the 1920s, they grew up with people around them who were very risk averse because of the 1929 Great Depression. So that had a huge bearing on investment styles in the US right up to the 50s when the bull market really took off. And the change that Charlie Munger brought into Warren Buffett. Warren Buffett was following the value investment style of Benjamin Graham till then, that let's look for undervalued good companies or undervalued companies and then see what is good and invest. Charlie put that on its head. He said, look for wonderful companies at a fair price rather than fair companies at a wonderful price. See, Benjamin Graham, being a 1929 product, had the cigar butt strategy. So he went and, just like Sir John Templeton, he went and put money into all the companies that had got really beaten down by the 1929 to 35 huge Great Depression. And John Templeton made his fortune that way. Benjamin Graham also did well. So Warren was looking like that, but Munger changed his thinking into wonderful companies at fair valuations. Today, Berkshire has Apple as its biggest holding. That wouldn't have happened if Munger hadn't happened in 1975 in Warren Buffett's life and investments.
Well, Mr. Bagga, that point that you made where Munger forced a shift in the way Warren Buffett looked at stocks by saying that you need not really look at the very, very undervalued stocks. Now, something like that is quite relevant today also, where the general feeling is that valuations have run up in most cases and it's very hard to get something even at a reasonable price in most cases. So, if you were to apply that saying, Munger saying in the current context, look for, good businesses at a fair price, how could a new investor to markets, how should he approach the market here, especially in an era where prices already in most cases, the general concern is that valuations are quite expensive?
Yeah, I would say, especially in a situation like India, Santosh, we have been very fortunate that, say, take a Sensex of 100 in 79 or say 500 odd in 84, 85 when it was really made, and then we extrapolated it back to 100 in 79. The market went up 100 times by 2006 when it hit 10,000 on the Sensex. Now, that's something that you see once in a lifetime. So my generation was extremely lucky, and I keep relating this. I was with the former head of Unilever's the other day. I was just sitting with him and we were exchanging notes, and I was telling him that in my time, first company on campus was Levers, which was paying 50,000 plus housing, which was a big thing, 50,000 rupees per annum. And Citibank was 55,000. That was the highest payer. And a few years later, the consultants came in and then it took off. Today, MBAs take something like 30, 40 lakhs as a starting pays. But we generation that saw 1,000 times, 5,000 times kind of increase in our incomes over our, over one generation of working. We were a very fortunate generation. And people who ask today that where is the value left, where is the growth left, we have not even scratched the surface. Today, the market has crossed 4 trillion. This economy is going to 7 trillion, 10 trillion. The market, even if it keeps a lockstep with that, will be an 8 trillion, 10 trillion market in not very much, like we are not talking 20 years or something. I'm saying within the next 10, 12 years, you could see a $10 trillion Indian market, if not sooner. So the growth in India is paying you handsomely. You have to look at that entire equation. Of course, there are very good fund managers. I met one the other day who was running a small cap fund, but keeping P ratios at 15. But I would not be too fussed up by that. I would not buy companies at 100 Ps also, unless you see that they're growing at 50% per annum and they'll make this very worthwhile. Then you can. But normally in India, we should not get so fussed up on valuations or India being at a premium to emerging markets or to developed markets, because the growth is there. India is 2007 of China. China was sitting at our economic GDP in 2007, and by 2011 they had nearly doubled it. We won't double it like China in 4 years, but we will double it in 8 years, maybe 10 years. But it's coming. It's not that it's something up in the air. You can see it all around. So I would say focus more on the growth and a fair valuation, not an outlandish valuation. But don't keep looking for the very undervalued shares, because they are undervalued because the market knows something about those. So it comes back to that inversion principle that Charlie Munger used to talk a lot about. Invert, always invert. So you have to ask that question, why are these companies not being valued when the rest of the Indian companies are getting such high valuations? And that was the mistake. I remember when value investing mutual funds came into India, their income fund used to do better than their growth funds, because they even in India at that time we would get 14% FD returns, and you could make a lot of money just by stripping the coupons of a US 64 scheme or a bond, government bond, and the income funds were delivering better than the value funds in India. And that's when this growth at a reasonable price kind of situation came into India, and the rest is history. We have 10 rupee NAV funds which are today quoted at 1500, 2000 rupees, and they've done it in the last 2 decades, 2.5 decades, not a very long time.
Well, Mr. Bagga, one more question. Now, again, one of those Munger's popular quotes, which he said that knowing what you don't know is often more important than being brilliant. So could you just explain this again in the context of investing, and could you also share your journey as well? I'm sure that initially, like most investors, you would have also made a lot of mistakes, and over time this the desire not to be right on everything, that would have also at some stage come to you. So can you just explain this for the investors at large, that what it means when you say that not knowing what you don't know is pretty much important when it comes to investing?
Yeah, Santosh, that's a very good thing. And I was doing a seminar with Samir Arora recently for a visiting European set of investors, and Samir was presenting, and then I followed him. And one very nice slide he had on elimination investing. He says, and that's the crux of this, what Munger said. I'll give you an example. He says, we classify investments into 3 buckets. Yes, no, and too tough to analyze, too tough to understand. So like technology, they stayed away. I remember 1999, and even the 2000, I think it was the 2000 meeting, Buffett said it would have been better, guys, if I had stayed home, because all his old economy companies had underperformed. March is when the Nasdaq starts turning, but still by May it had not come down as much. So Warren Buffett was joking that better if I had not come, because he had given very bad returns, because anything with .com behind it was just doubling every 2 weeks or 4 weeks and stuff like that, and 100, 200 P ratios. People were saying that this time it's different. All those playbooks were coming. Within a year, he was the top performer fund again. And that's what they said. Yes, no, and too tough to understand. And I think that plays out. There's a very famous story that Charlie has quoted in one of his speeches. And it goes on Max Planck, the famous German physicist, who got the Nobel Prize for his quantum mechanics work in 1918. He got a Nobel Physics Prize. And Max Planck used to go around the country lecturing in various cities, universities, and his chauffeur would go with him. And then one day the chauffeur said, Herr Planck, I have a request. So he said, okay. He says, I have attended each of your speeches. I know it by heart. I can deliver your speech. It's very boring for me to sit in the audience. Will you allow me? We are going to Hamburg. Will you allow me to do your next speech? And you wear my uniform and cap and just sit in the audience and see. So Max Planck took it as an experiment. The chauffeur delivered a faultless speech, and because he had seen him perform 30, 40 times. And then one erudite professor got up in the audience and he asked a very abstruse question with equations and stuff. But the chauffeur was very quick-witted. He thought on his feet and he told him, "Oh, Professor, I didn't expect such a simple question from such an erudite professor. Even my driver can answer this question. In fact, I will ask my driver to answer you right now." And that's how he got out of it. And what Munger said, there is two types of knowledge. One is the Max Planck real knowledge. You have worked hard for it. You have ground yourself with experience in building that knowledge. And the other is the chauffeur knowledge, where you can, up to a limit, an inch thick, you can carry it away. And that's the problem today, Santosh, especially with financial influencers, everybody masquerading as a successful investor. And the people find it very difficult. And in an unregulated industry, you don't know who's right, who's getting paid. You keep getting calls that I'll pay you this many lakh rupees. Please be complimentary about this product. You look at, say, a Ronaldo or somebody will earn $3 million for one Instagram post. So that knowledge is Max Planck chauffeur's knowledge. And we saw that in crypto. It came home to bite when a lot of US influencers had to pay fines to the SEC when cryptos burnt down because they had taken money to push these. So the knowledge you have to see, and what Munger said was build your lifelong knowledge. He talked about a lot of models and how to bring models into your analysis. The models help you then to understand an investment and knowing the edge of your incompetence. That was the question you asked, that knowing what you don't know. The overconfidence kills the investors, because in the bull market, your book itself was about the bulls and the bears. I remember reading your book on the Indian markets. The bull market creates that sense of overconfidence that I am responsible for these returns. In the bear market, we tend to blame the market, that everything is down. The competence lies in knowing that how little you know and how the markets are a complex adaptive mechanism with a forward discounting. So it's like predicting the weather. Nobody predicts correctly. Very difficult to even do the fundamental analysis. Munger would joke that Warren keeps talking about discounted cash flow, but I have never seen him calculate even once. So he said, we have our method and we use it, but they don't have a computer. They read the whole day long, and that's how they spend their lives. And if you see this time's Warren Buffett's letter, it was a very short letter. Maybe after Munger going, now all of us are thinking how long more for Warren. But short letter, he said we made probably 12 great investments in our last 60 years of investments, which was quite an eye-opener, very small letter, worth reading. Every seminar of mine, I tell people go and read that 10-page letter. And he gives examples of, how he picked up Coke, how he picked up Amex, and over 30 years, now he makes more in millions of dollars in dividends than what he initially put in those companies. Apple itself, I think, if Warren stays another 5 years, we will get a great treatise on his Apple pick. Or was it, the new generation which picked it up? I think we would like to know more. But this was their edge of competence, and knowing that the technology part goes into too tough to understand, and they were happy with it. They were not envious of the people making the money, and that's why that was the secret of their longevity.
Right, Mr. Bagga, Munger was pretty critical of the Abita metric when looking at the company earnings, right? This is one metric that analysts closely look at. So what are your thoughts on that?
See, it's an old world theory that how do you calculate the cash flow and how much cash is actually available and how much is attributable to the business. So he used to say that these adjusted earnings, there's EBITDAs and all is really, he says the kings used to get astrologers to cut open sheep or pigs and study their entrails and tell the future. And he would say managements are doing the same, and the accounting board has allowed the management to get away with this. And actually, if you look, Nandita, like, excuse me, if there's a lot of offshore, off-balance sheet financing, for example, you might be totally misled by seeing that, oh, the company's debt burden is low, because it might be sitting as a rental in the expenses. So hundreds of ways by which companies are gaming. Yeah, you remember when the new age companies got listed a year, 2 years back, and they were analysts who were giving 2050, 2060 kind of reports and defending them. And, we don't know 1 quarter ahead, or we don't know 1 year ahead of these companies, and to build a 2050 model. And then to say that operational earnings have turned in the green, all those things he would say that it's a lot of mess around. And some part of it I would totally agree. And, if you go back to the accounting principles and recast balance sheets, you realize, a lot of fancy companies come out with huge capex plans. If you add on everything, maybe they are a net cash flow negative, which would be a red flag. But these companies get huge valuation premia because they are showing growth. But if you add on at a reasonable valuation, at a reasonable price, then you would get that. So calculating the cash flow is an art, and it's good to go by the first principles, taking out all these things which are allowed by accounting standards, but which might not work for the investor.
Right. Just a last question to you, Mr. Bagga, since we are running out of time. Of course, the absence, Munger's absence at the AGM will always be felt. Of course, you have shareholders and investors from across the world going to Omaha for this event. Have you ever had the chance of attending any of these AGMs, or do you plan to do so? And AGMs will never be the same now, because we've always seen, we've always had the sight of Munger sitting next to Buffett, but there will be a void of sorts. But are you looking to now go and attend the AGM sometime?
I would love to, but I'm too lazy to organize everything on time. But quite a few friends have done it, and so one gets the first-hand information. This time, in fact, people were very keen that both of them, given their age, every AGM becomes that, is it the last one? But Nandita, I think, given how AI is progressing, it might not be very impossible that we get a hologram of Munger sitting there with Warren and answering questions, because there is a huge body you can get thousands of pages of their speeches, their talks, their insights. And if that is fed in an AI model, I think we could continue to benefit from them. But this time around, probably Greg Abel, the insurance head, who's about 61 years old, I think he'll be appointed vice chairman. In 2021, Warren had said that he's probably the anointed successor. So amongst the three, heir apparents, I think Greg Abel might be the one coming up, sitting with Warren in the seat now emptied, unfortunately, by Munger moving on. But I would not be surprised if an AI avatar of him comes by and answers some questions at least.
Of course, we will be watching out for that AI avatar as well, and of course, we'll be watching out for the announcement as to who will be filling in the gap of the vice chairman of Berkshire. With that, Ajay Bagga, thanks a lot for taking out time and sharing your thoughts and of course your experiences and your key takeaways from this rich legacy that we call Charlie Munger. With that, it's a wrap from me and Santo. Thanks a lot for tuning in, but of course, you stay tuned to Money Control for all your other news and updates.